So if the economy is doing so well, why do most Americans say that they are financially worse off? Hi, everyone. I'm Mike Wilkerson. This is the Stormwall Advisors Monthly Update for December 2023. We're going to hit on that question and many others. I'm the founder of Stormwall Advisors. I'm the host of Stormwall.com, and I am the author of Why America Matters. If you haven't picked it up or you haven't read it, please go to Stormwall.com. You can get it there. You can also go to Why America Matters and learn more about it. But it's a great book, and it's got a lot to say about the situation that we're in right now. Assuming you're watching this on YouTube, if you can give it a like, give it a share, share it with others, subscribe, turn on the notifications bell. I am providing content there and on Twitter every week, new information around whether it's the economy, geopolitics, or other issues. And let's get into this today. So it's the first week of December. We've seen a lot happen. I'm going to jump over and share my screen with everyone. Let's make sure that we can make this work. I did that wrong, so here we're going to do it again. Right. Okay. I think this is it. Super. Okay, so here I am, and I'm going to move myself out of the way so you can see more of the screen. We're going to move through this pretty quickly. I want to talk about a couple of the events that have happened in the last few weeks. So in the economy, what we've seen, and we're about to get into this, is that inflation has come down, but we've seen GDP growth going up pretty significantly in the third quarter. So I want to talk about that and what it means and whether this is a real thing or not. We're now at the end of 2023, and all the calls from really the vast consensus of economists and market analysts was for recession this year. So we're going to talk about whether that is now off the table or whether we're going to see something happen later on in 2024. And a couple other important points. The government spending is now resulted in a $1.7 trillion budget deficit in the U.S. for the year, for the fiscal year that just ended in September. And now we're sitting on a cumulative deficit of $21 trillion since the turn of the century, since 2001. With that, national debt is nearing $34 trillion, with annual interest, the cost to service that debt running at an annualized basis of $1 trillion. And then if you look at where we're going with the debt rising at 5%, that is likely to grow closer to $2 trillion. In the wake of all of that, crypto, especially Bitcoin, is having a bit of a bull run with Bitcoin above 44,000 in the last week. And then, of course, on a geopolitical perspective, which we're not going to get into a lot this time, ongoing turmoil in Israel, with Israel and the Middle East. We're seeing waning support in the U.S. The Senate has declined to fund additional funding to the Ukraine, and then we've seen this onslaught in the last few weeks of conservative political wins across Europe and in Argentina. But let's move on. Talk about Consumer Price Index, CPI, the measure of inflation most commonly used, fell this past month to 3.2% for October, kind of back down to where it was in the summer. We had the spike in the fall due to rising energy costs. Those prices have abated a bit. People get very optimistic about this, and what was fairly surprising was that GDP growth in the third quarter on a real basis, meaning after that inflation effect, which was 3.7%, real GDP growth was 5.2%. And this was pretty surprising. I mentioned that the previous consensus among market analysts was for a recession. Think about, we had rising interest rates, had tightening credit, we had the actual banking crisis that started in March and kind of carried out through the second quarter. We're still seeing some effects of that, by the way. But nonetheless, we got 5% growth. So how did that occur? What happened? Well, there are a number of reasons. One that I want to focus on today is the impact of Bidenomics, which is really another a code word for fiscal stimulus, government spending. We've seen it through the Inflation Reduction Act. We've seen it through the so-called Infrastructure Act, the Infrastructure Bill, the CHIPS Act. And what we're seeing is pretty significant growth out of the federal government in things like defense spending, which grew at 8.2%. Overall regular entitlements from the government through these programs, through the Inflation Reduction Act and other things. And this is resulting in a big stimulus to growth and a big impact here on GDP, even though the consumer has fared less well, or is growing more slowly. And if you look at where the consumer spending is coming from services, it's really housing, utilities, healthcare, food service accommodations. All of these costs, prices, even after whatever impact they're using to show inflation, I believe is underrepresenting the actual inflation. And the reason why we're seeing growth from the consumer in these areas, is not because of a wealth effect, but because the inflation factor component of prices rising is being underrepresented. All right, so if I can get this to move on. So now all the talk is, okay, no recession. Are we going to have a soft landing? Basically no recession at all? Or is this just a delay and a pause? And we're seeing it on both sides. You see this interesting chart on the left. It's basically saying from Statista saying, okay, looks like everything's going in the right direction. We've had job gains. We've had continued low unemployment rate. Inflation is coming down. Surely it's the end. But others are arguing, including Edward Chancellor, who is the author of The Price of Time, talks a lot about interest rates and the Fed and all the things that have gone on to distort the economy, argues that this is unlikely. And one of the main reasons is the best indicator of whether a recession is going to come has been over time this what's called an inverted yield curve, meaning when short-term interest rates are higher than long-term interest rates, it's most times, not always, but most times has been a clear sign that the economy was headed for a recession. We've been in that place for a while now, since 2022, actually, where short-term interest rates have been higher than long-term rates. Without getting too technical, the point is just basically that it's a warning signal for the economy. And oftentimes the delay between that inversion of the yield curve and recession can be as long as a year or more. And so even the New York Federal Reserve, they have an indicator, a recession predictor, and they still argue, or at least their data show, that a recession is more likely than not between now and the end of 2024. Now, I want to get into the heart of the question, which is, despite all this growth, why is the U.S. consumer suffering? And so it's interesting, if you look at all Americans, American voters, 55% of them say that they are financially worse off under the Biden administration than they were 4 years ago. Now, it is true that this does split a bit on party lines. 82% of Republicans say they feel this way, whereas 46% of Democrats say no change. All right, we're not worse off, but we're not better off. That's true. Only 31% feel worse off. So I want to ask, why is it that most Americans from all political affiliations feel like they're worse off, despite the touting of the economic growth figures, the GDP growth figures from the media and from the Biden administration? And I want to come back to something that I've been talking about all year, which is the shrinking wallet. In other words, the effect of inflation on Americans' purchasing power. The Fed has been unable to really address inflation. And I know we started the segment by talking about inflation has come down, but keep in mind, it's still well above the Fed's target rate of 2%, number one. And number two, and I've talked about this on previous segments, that the CPI and inflation statistics are grossly underestimating the actual real felt cost of inflation that Americans are going through. So despite CPI coming down, despite nominal inflation coming down, I do not believe that we have tamed the inflationary monster, as this cartoon illustrates. Even if prices truly are stopping their growth, their rapid growth, the effect on the consumer the damage has already been done. In other words, when you have inflation of 3%, yes, it's lower than it was when it was 8% a year ago, but prices aren't going down. They're just growing less quickly. If you look at the purchasing power of the dollar today versus 2020, at the start of the pandemic, Americans have lost somewhere around 16-17% of their purchasing power since then. If you go all the way back to the beginning of the century, 2 decades ago, when we had since then the global financial crisis and all the money printing and monetary expansion that went on then, and then a second round of massive money printing and monetary expansion during pandemic lockdowns, government response, handouts, all that sort of thing, Americans have lost 45% of their purchasing power in 2 decades, in one generation. So someone who started working, let's say you were 25 at the turn of the century, you're now in your late 40s, thinking about retirement now. All of a sudden your savings, your income, which may have grown, but it has not grown as much. Absolutely, real wages have not kept up. You're significantly worse off. And this is the reality that Americans are experiencing, is that loss of purchasing power. And by the way, if we continue with inflation, even if real inflation is 5% over the next 2 years, the dollar will have lost over half of its purchasing power. I've shown this before, but just to bring a reality check to the whole situation, I looked earlier in the year at the CPI index from the Bureau of Labor Statistics at various categories for that same 3-year period since 2020. And what do we see? What we are experiencing is that fuel, oil, gas, energy products generally now cost 70–80% more than they did 3 years ago. Cars are still up, used cars some 47%. Across the board, everything has increased significantly, double digits. Transportation 30%, utility gas 30%. Shelter is now, while it was lower over the 3-year period, is actually now becoming more and more expensive, and is likely to be one of the most rapidly rising price categories in all of U.S. inflation. I want to shift gears now, though, and talk a little bit about what some of this means for the U.S. As of a couple of days ago, the U.S. national debt was just under $34 trillion. Think of it this way. It's $100,000 per person. Now, not everybody pays taxes. We've got people who don't pay for financial reasons. We've got people who don't pay for AIDS. That's just on the per capita basis. If you're a taxpayer, your debt per taxpayer is over $250,000, $260,000 per taxpayer. No wonder there's a sense that things aren't going well and that we're in trouble. The U.S. is now the 3rd most indebted country in the G20 at 129% at the end of the year of GDP. Only Japan and Italy are actually worse off. The Euro area much better off. The BRICS nations also significantly less indebted, and that eventually catches up to us. The challenge is that debt growth is not just sort of growing slow and steady, it's actually increasing at an increasing rate. It's up 50% from pre-pandemic levels. It's tripled from the years before the global financial crisis. And in 1 year, the national debt has grown by over $2 trillion. With that comes interest expense increasing, as interest rates have gone from essentially zero to $1 trillion on an annualized basis. We are spending more now on debt service than we are on the military, on healthcare, other entitlements. This has become the #1 item, the largest item on the federal balance sheet. You can see it a different way by looking at how debt service costs have been growing quarter on quarter. Back in 2000, they were actually shrinking as interest rates were very low. Then it starts to grow. It grows with the rise of interest rates, whereas over the course of last year, it was growing at double-digit levels. Even now, in the most recent quarter, debt service costs have grown 8% quarter over quarter. That is a result of what you're looking at now, which is 20 plus years of cumulative federal budget deficits, now totaling nearly $21 trillion since the last time we ran a surplus in 2001. That is not sustainable. We are in what I've described as the deficit debt inflation doom loop, in that those deficits result in the need to print more money, raise more debt, which in turn is pro-inflationary along the way. So I want to focus in on this because I think in spite of the economic growth, I think where the U.S. is really at risk, where the economy is really at risk right now, is in this issue of the national debt and the potential for a debt crisis to become a credit crisis. And it goes something like this. The Federal Reserve really can't reduce interest rates right now while inflation remains above 3%. The U.S. Treasury, because of the deficit, because of its large budgetary needs, needs to roll over literally trillions of dollars of debt. And in order to attract investor interest, it has to offer a positive interest rate. Positive meaning that there has to be a real interest rate above the rate of inflation. So if inflation is 3% plus, the real rate on U.S. Treasuries needs to be somewhere in that 4.5%, 5%. In order to attract investors. So what's happening is the U.S. is rolling off debt that was at 0%, 1%, something in that range, 2% maybe, with 4.5%, 5% debt. With that, in order to pay the interest on that debt, government has to issue more paper, more debt in order to make those payments. This means that we're going to see higher interest rates for longer. That in turn is going to have a knock-on impact in the banking sector because banks are sitting on trillions of dollars of unrealized losses where they haven't been forced to show those losses through their P&L, through their income statement, and reduce capital. They've been able to basically park them in the hopes that because they're what's called held to maturity, that as long as they hold on and interest rates come down, they will ultimately be made whole on those debts. With interest rates remaining higher for longer, the consequence is at some point, really beginning this coming year in 2024, a number of these banks' exposures, positions are going to have to be marked to market. They're going to have to move these assets to available for sale, which means they'll mark them to market. They'll take the loss. It'll be diluted. It'll hit capital, and we're going to find that we will see another round of banking crisis with deposit runs and bank failures in 2024. If that happens, if we see this scenario turn, or there is a sharp negative reaction to U.S. government debt. In other words, if investors, whether other countries, sovereigns, or private funds, stop wanting to buy U.S. debt or stop wanting to buy it at any reasonable price, we can see a very severe and very sharp market reaction in that environment. Move on. So just a few takeaways here, and then we'll try to wrap this up. It's really fiscal stimulus from deficit spending that is driving a lot of the growth we're seeing in the economy. This will lead to more inflation. And of course, as long as we are continue to be engaged in conflict in Europe, in the Middle East, a war is always inflationary. This is for governments the way that things start to go wrong, is trying to fund wars over a long term. Consumer spending is, as I mentioned, in real terms, is more about housing, utilities, and healthcare, not really sustainable without greater real wage growth. The looming government debt disaster is being ignored by the market, but at some point the game will be up. Crises like this, to use the old adage, arrive very slowly and then suddenly, and it will be disastrous when it materializes. We talked about the banking crisis, 1.5 trillion in unrealized losses. Expect another round of failures next year. Now, on the question of recession, going back to the heart of it, will we see it in 2024? The Fed says it's still more likely than not. But if the Fed cuts interest rates, then I think we will expect higher inflation and more asset bubbles, not a recession. I think they will use economic stimulus to keep the economy moving, keep people employed, even if it means they're bringing forward an inflationary monetary crisis. That's it for now. Let me pop out of that and say thank you for watching. Again, if you're assuming you're watching this on YouTube, give it a like, share it, subscribe to my channel on YouTube, Stormwall channel, and we look forward to seeing you next time here on the Stormwall Advisors Monthly Update.